The great debate: stocks or bonds in 2025. Are US stocks overpriced, or are they still your best chance to grow wealth? With bonds offering their highest yields in years, many investors are rethinking their strategy. Look, we're talking serious moolah here, folks, the kind that can make or break your financial future. So, should you stick with stocks or make the switch to bonds? That's what we're gonna hash out right here, right now. We'll break down the numbers, look at what the big money players are doing, and help you decide where your hard-earned cash belongs in 2025. Buckle up, because we're diving headfirst into the world of finance. The tides are turning. We were talking about the equity risk premium, right? It's like trying to predict the weather, but instead of rain, we're talking about your returns. Low interest rates made bonds about as attractive as a root canal, pushing everyone and their grandmother into stocks. But now, with interest rates finally waking up from their nap, bonds are looking sexier than ever. We're talking about some of the best bond yields we've seen in years. Why is this such a big deal? Because it's a signal, a sign that the balance of power might be shifting. For years, stocks have been the life of the party, but now bonds are putting on their dancing shoes and ready to steal the show. Think about it. When was the last time you saw bonds offering real competition to stocks? It's been a long time, folks. But this shift, it's got the potential to shake things up big time. Investors, big and small, are starting to rethink their game plans. And trust me, when the big money starts moving, you better pay attention. This is a wake-up call, folks. The game is changing, and you don't want to be caught napping. So, you're probably thinking, Jim, why does this all matter to me? Let me break it down for you, because this is where the rubber meets the road. For the first time in a long time, bonds are offering a real alternative to stocks. We're not talking about your grandma's savings account here, folks. We're talking about yields that can actually make a dent in your financial goals. We're talking 4 to 5% yields on US Treasuries. That's real money, folks. And guess what? The earnings yield on the S&P 500, it's sitting right around the same range. Historically, this kind of convergence, it's like a siren song for investors. They start to see the appeal of those steady, reliable bond payments, and they start shifting their money around. And when I say shifting money, I'm talking about billions, folks, with a B. Listen, when those institutional investors, the big dogs on the block, they start sniffing around something new, you better believe the rest of the market follows. It's like a flock of birds, they all move together. This is why you need to pay attention. This isn't just some abstract financial mumbo-jumbo. This is about your money, your future. The choices you make today, they're gonna have a ripple effect for years to come. So buckle up, Buttercup, because we're about to dive even deeper into this market showdown. Let's take a trip down memory lane, back to the trenches of the financial markets. History, my friends, has a funny way of repeating itself. Remember the dot-com bubble? Back in the late 90s, everyone and their dog was piling into tech stocks. Valuations were through the roof, everyone thought the good times would never end. But guess what? That bubble, it burst. And it wasn't pretty. Then came the 2008 financial crisis. Talk about a gut punch. Stocks tanked, people lost their shirts, and the world went into a collective panic. But you know what happened next? Stocks became so ridiculously cheap, so undervalued that they became the investment opportunity of a lifetime. And those who had the guts to buy during those dark days, they were rewarded with a decade-long bull market. The point is, folks, the balance between stocks and bonds, it's always shifting. It's like a giant seesaw, constantly going up and down. And right now, we're at another one of those pivotal moments. Bonds, they're offering that stability, those steady returns that make your heart beat a little slower. Stocks, on the other hand, they're still the wild card, the potential home run hitters. Especially in sectors like tech, AI, healthcare, those are the engines of future growth, folks. The question is, are you gonna play it safe with bonds, or are you gonna swing for the fences with stocks? Alright, enough with the history lessons, let's talk about you. What should you be doing right now to navigate this market madness? Here's your 3-step action plan. Step 1. Diversify. Don't put all your eggs in one basket, folks. A balanced portfolio, that's your secret weapon. Stocks, bonds, maybe a little real estate on the side. Spread that risk around like peanut butter on toast. Step 2. Focus on quality. Look, I love a good bargain as much as the next guy, but when it comes to your hard-earned money, you don't want to be messing around with penny stocks and fly-by-night companies. Stick to companies with strong fundamentals, solid track records, and a bright future. Step 3. Keep your eye on the prize. And by prize, I mean interest rates. Those babies are the key to this whole shebang. If rates keep climbing, those bond yields are going to get even more tempting. So, stay informed, stay vigilant, and be ready to adjust your portfolio accordingly. Remember, folks, investing isn't a set-it-and-forget-it kind of deal. It's a dynamic process, constantly evolving. You gotta stay informed, stay engaged, and most importantly, stay ahead of the curve. So, there you have it, folks. The lowdown on the epic battle between stocks and bonds. It's a tough call, but armed with this information, you're ready to make smart decisions for your financial future. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell. And let me know in the comments. Are you team stocks or team bonds in 2025? Let's get this conversation started. Remember, knowledge is power. And in the world of finance, that power is yours for the taking. Or the